Hello, everyone. Welcome to today's webinar on RHC cost reporting on how to optimize your Medicare rate for the Rural Health Clinic. Rural Health Clinic cost report. Today's date is September 26, 2024. This webinar is being presented by Healthcare Business Specialist as a part of the Rural Health Clinic Information Exchange. And here at Healthcare Business Specialist, this is our team of people. As most of you know, I am retiring at the end of this year, and we've hired somebody new to come in and work on cost reports as well as our current team of Dani. If you do want to do cost reports, send those requests to Dani, and she'll take care of getting the agreements and HIPAA agreements and all that sort of stuff that you need to get a cost report prepared for you. Of course, Paige Chambers, she works with our emergency preparedness and preparing cost reports if you have any needs there. And then Trent has been working with us on the program evaluations, RHC cost reports, getting people ready for certification for RHC. So there is my announcement that I think it came out on Facebook this week. So I'm looking forward to December 31st and doing something besides this. I've been doing it for 35 years, so I appreciate everybody putting up with me for that long. It's been a fun ride. And here are the services that I just talked about that we do. If you are in Tennessee, we are doing TennCare quarterly reporting as well, as long as that goes on. That may go away soon, so which would be nice, but we'll see how that goes. But those are the services that Healthcare Business Specialist provides. If you're not a member of the Facebook group, please join. We have 5,400 members in there, and you can ask questions. We will post information in there. The other consultants will post information and answer questions. If you have something that would be of value to the community, you're welcome to post it. If you have a webinar, if you have something going on that would help the rural health clinics in your area, then please post it, because we want to be a benefit to our rural communities. This session is being recorded. It will go on our YouTube channel, and you can watch it there. If you got somebody that misses it, or if you need to leave early, you can do that as well. This disclaimer, again, it is being recorded. I did use ChatGPT to summarize some of the Medicare rules. So you'll see that in some of those. I basically put in a lot of the writing just to give you some more detail. I probably won't go over that stuff as well, but I just want to provide it to you just in case you need to look something up. And then don't make any changes based upon what I'm telling you. Do consult your cost report preparer if you want to implement any type of change based upon what I'm saying. And Dani and Paige and Trent are all on the line here, so they will probably join in at some point on here, and they may correct something I say wrong, or they may just add to what I'm already saying. So if you do have questions, you can put those in the question box there, and we will try to answer them either as we go along. Dani, I'll let you decide on when to ask the questions. If you want to save them for the end, that's fine. Or if you want to, if it's something that we need to ask during the session, that's fine too. The slide presentation is about 60 slides. It is in your handout over on the sidebar. The presentation itself may not download because it's huge, and sometimes GoToWebinar is sort of wonky about that. I did post them in the Facebook group, and I did put them on our website at ruralhealthclinic.com. If you just go to the homepage, you'll see it there. And then we are not offering certified RHC professional credits for this particular webinar. So sorry, we just can't give them for people that watch the recording, and it just ends up being uncomfortable. So we decided we're just not going to do it. Today's topic, we'll talk about how the Consolidated Appropriation Act has changed the playing field for our rural health clinic cost reports and what's important to you guys. And that leads into the importance of interim cost reporting to see where you stand, because you are playing at the high stakes table now. Before, when the rates were going up by 75 cents a year or $1.25 a year, the changes didn't matter a whole lot. But now that the caps have gone up by $13 a year for your independent RHCs and for your newer provider-based RHCs, there can be some big swings. So we'll talk about that. And then how to get your accounting system set up to capture all these different costs that you have now. There's all these different services that that on the cost report that may or may not be a part of your all-inclusive rate, may or may not be counted as a visit on your cost report. And so the complexity has gone up by tenfold since we got. And now this is Polly, she's coming in for the webinar. But and also what the impact of your entity is on allowable compensation. That is a big issue, especially with your independent clinics. The way that your entity is set up legally makes a big difference on what you can claim or not. So we'll talk about that in some detail. And then here is the impact. Basically, we've gone from playing checkers to Harry Potter wizard chess, which I have no idea what that means, but it sounded cool. And because the caps have gone up so much higher for independent rural health clinics, our rates have gone up dramatically, which is great. We're going to actually be able to recapture a larger portion of our cost. And it sort of shifted the dynamic that we had before the CAA, which was, I would tell our clients, hey, you want to push everything to Medicare Advantage because you actually get paid much more from Medicare Advantage. Now that pendulum has swung to where you basically get paid the same amount, whether it's Medicare Advantage or traditional, but soon the pendulum will go to where traditional Medicare will be paying you more than your Medicare Advantage plan. So the key to this is reach out to your Medicare Advantage plans and just see how they pay. Actually, some Medicare Advantage plans actually pay you more, even with the higher rates, because the way they handle preventive services and quality measures, it works smoother. And if you do a lot of that, you could be better off on your Medicare Advantage plan. So, cat just knocked over a big thing. I don't know how she did that, but she did. And then next is all provider-based RHCs are subject to a cap. Before they were not. It was an uncapped rate. And so now starting in 2020, 2021, there is a cap for all clinics. There's a grandfathered cap on those particular provider-based RHCs. And then provider-based RHCs that came in 2021, there is a national statutory limit for them, which we will show you. What this means is that all RHCs, you're gonna have to manage your money, your cost better. You have to keep better cost report records than you ever have. The days of using Excel and ledger sheets are gone. You need to keep really good records, at least at a bare minimum. QuickBooks, get some QuickBooks and do that. That is the bare minimum that you need to have a good compliant cost report. These results have changed. These changes have resulted in large payments from Medicare, which is great. You love being on that side where you get a $100,000 settlement from Medicare, and that can happen when the caps go up by $13 a year and you have a lot of visits. You could get a large increase. On the downside is, with that cap increasing by $13 every year, and a lot of the MACs will give that $13 increase to you automatically. But if your cost per visit doesn't increase by that amount, when you get around to filing the cost report, you could end up owing back 150 grand. That's never a pleasant conversation to have with anybody, but we've seen it happen. So that's why it's important to do interim cost reports during the year, to see where you stand. You could be, in fact, the interim cost reports are great, because if you see that your cost per visit has gone up and you're still below the payment that Medicare has set your interim rate at and still below the national statutory limit, you could send in an interim cost report to your MAC, to Palmetto, to Novitas, and say, hey, our cost per visit's now running $139 a visit, and you're only paying us $128. We want you to give us an interim settlement, and we want you to increase our rate to the 136 or 139 or whatever that amount is. So that's another reason why these interim cost reports are a good thing. Another impact is that cost reports are taking way more time than they did before. We have to flesh out all these little things that are going to different places. If you in the past, you would send us a little listing that says outside services, and that would be your category on your general ledger. But we have to call through it to see, okay, oh, there's some of it's to chart span or to vital sync or to thorough care. That's going to be for chronic care management. Oh, here's stuff for an LCSW. Here's stuff for a PA, for a nurse practitioner that we've contracted with. Here's something for HBS for doing the cost report. All those things go to different places. So set up your accounting system to where if you have different types of outside services, you keep up with them through your accounting system throughout the year. That's going to save you the trouble of going back and culling through your detailed general ledger and seeing what you did. And we almost invariably have to get a detailed general ledger from you. So get that QuickBooks, get whatever you have that can create a detailed general ledger so we can see where you spent your money, and ideally put everything in the right categories up front. And we'll go into telling you more about that as we go through this webinar. But the key is cost reports take much more time than they did. You need to get your information in early as possible. Thank goodness I will not be doing them this year, but Dani and Trent and Paige and Madison will appreciate it very much, because if you don't get this stuff in, a lot of times they don't get filed on time. If you don't get filed on time, Medicare cuts your payments off, and that's not a good situation for you because your payments get cut off. We can't file the cost report unless we get the information to file it. So keep that in mind. These changes have a huge impact on you guys, and this is why we're having this. So you basically, it's almost a full-time job now on cost report. Before, back in my day, we would get the cost reports the last week in May, get them filled out. I mean, the caps were so low that, even I, as idiot as I am, could get it done and get you maximized. Now, it is so complicated that you really have to spend time getting it done. And during the year, keeping up with everything and doing what you need to. So I'll put together a plan. Again, that's in your handouts there as well. So you can, that's a cost report plan. And then I'll put together a little to-do list here as well on some things that you should be doing each quarter of the year to stay in compliance. So this will help you just remind yourself to put this on a tickler file and get it going. So here is just another summary of the changes. I think I've told you these. Independence and independent RHC is owned by physician, nurse practitioner, a PA. Sometimes they're owned by hospitals as well. And then there's also a provider-based rural health clinic, which is 99.9% owned by hospitals, and they meet certain criteria. And the provider-based RHCs that came in before December 31st, 2020, and a few stragglers after that, those are grandfathered. The rest of them, the provider-based RHCs, have the same national statutory limits that I'm going to show you on a slide coming up. Do all the payers have to pay you this new all-inclusive rate or national statutory limit rate that I'm talking about? No, this only applies to traditional Medicare, and there are a few Medicare Advantage plans that will pay it. So reach out to your Medicare Advantage plans, ask them how they pay rural health clinics, what you need to get set up as one, and then look at their contract to see if it is actually better. That is a to-do for you. And now my cat's in the way. Okay. And then one thing that people always look at is your visits. Everybody thinks, oh, the more visits we have, the better our cost per visit is. Well, it has an inverse relationship to that, because the way the cost report works is it takes your total expenses divided by your total visits, and whatever, if those visits are higher, your cost per visit is lower. And so we see a lot of clinics, they want to add nursing home visits to their Medicare RHC cost report, because they think, oh, that's really, we got a really good rate from Medicare. It's almost double what we would get if we build it fee for service. And a lot of nursing home nurse practitioners and physician groups will ask you to run their stuff through your nursing home, which is perfectly fine. There's nothing wrong with that. The only thing is you got to watch it very closely, because that will increase your number of visits, and it tends to tank your reimbursement rate per visit, your all-inclusive rate. So another reason why interim cost reports are so important. If you're doing something like that, you're going to need to see what that impact is, and just make sure you know what you're getting yourself into. Here are the caps. You can see you don't get paid. A lot of people see this. I had a consultant the other day call me up and say, Mark, don't we get the full cap every year no matter what? I was like, no. It's the lesser of this number here, this national statutory limit, or your actual cost per visit. So a lot of people think, oh, we're guaranteed to get $190 per visit in 2028. That's not correct. It's whatever your cost per visit is, or $190, whichever one is less is what you're going to get. So keep that in mind. It's why these cost reports are so important. And here's some numbers that I use. I'm just going into 2028 and just doing some projections here. Typical Medicare, this is traditional Medicare. Our clinic here is a small clinic. We have 10,000 total visits. 20% are traditional Medicare, so that's 2,000 visits. Medicaid is about 30% of our business, and then our other payers are about 5,000 visits. Our expense per visit is $190, because remember, we have to take our expenses divided by our visits, and it comes up to $190 per visit. So our allocated expense for Medicare was $380,000, Medicaid was $570,000, and other was $950,000. So we spent $1.9 million to get our cost per visit to $190 on this 10,000 visits. The math is pretty simple. Our average payment from Medicare, $190. That's beautiful. We broke even on it. That's what we want to do. Our Medicaid rate, and our Medicaid rates are, I've always say, if you've seen one Medicaid program, you've seen one Medicaid program. And so I'm using 140. Your state may be completely different, but I'm just going to use 140 for right now. For your commercial insurance, I'm going to use 160. And then on average, it actually averages up to $160 per visit when we average these three together. And as you can see, that gives us we collect 1.6 million. We actually lose $300,000. And the reason is our other payers are not paying us at $190 per visit. So that's the reason why this math doesn't work. You're not going to be able to reach your cap. Everybody's goal is to reach your Medicare cap. And a lot of you guys, I know we've had a few folks that like, oh, I've always had my cap and I missed it this year. And yeah, that's going to happen more and more as these caps go from 139 to 152 to 165. You're going to be just like Polly here, just calling and saying, why can't I get any more money to get our cap, get our visit up, our costs up? And you're not going to get there. I just hate to tell you that. So some of the things that we're going to help you is RHCs are paid at the lower of the national statutory limit or actual cost. Yeah, I've said that 10 times already. Value of services is a non-cash item that you could use to inflate this number here. There's 150 that you can't see me reaching there, but yeah, the 150,000 here. You can. Everybody is bothering me. I don't know how to turn that off either. 150,000 here. We can use that to help get your cost per visit up without spending cash. And then your average collection from all other sources is important to obtain a higher rate. So what you want to do there is basically look at your revenue cycle is so important because you need to collect more and more cash from them to fuel this RHC rate. So that's something important. Remember, we talked about nursing home visits. That's great to do, but just remember, it could have a draconian effect on your cost per visit and your rate per visit. Also, you guys may be adding a lot of services that aren't a part of the all-inclusive rate. Things like this chronic care management, there's like this list of 17 different CCM items that you can do, which are great. You can do, glucose management, remote monitoring, chronic care management for the patients. All of those are great services. They are not a part of your all-inclusive rate. So the more of those you do, the less your AIR is. Now, that still may be a good thing. You'll probably net more cash in the long run, but they tend to drive down your AIR. So again, why there's planning needed for this. If you want to see the actual numbers, here are the actual numbers of a clinic a cost report that we just did. It's a March 31. What we're doing is comparing pre-COVID to after COVID. And so March 31, 2020 numbers here, and then March 31, 2024 numbers, and then we're just looking at the variance and the percentage changes. This is a relatively large clinic, maybe 5, 6, 7 doctors. They have about 53,000 visits every year. They have pediatrics, they have OBGYN. So it is a full service primary care, pretty decent size practice, probably one of the top 25 in the country. And not a lot of traditional Medicare visits, 5,700. This was in 2020 out of 53,000. That's about 8% of their business is traditional Medicare. That's actually dropped in 2024 to 4,099 out of 53,000. So, and that is the trend that we're seeing. Medicare MCOs Medicare Advantage plans are more than traditional Medicare patients now. That's just happened over the last few years, and it's continuing to go that way. So they only have 4,099 visits there. Our total charges, you can see they went down in total over that 4-year period of time. However, our charge per visit went from 176 to 229. Look at your charges. If you haven't looked at them in 4 years, we're living a different world now. The prices, inflation, mortgage rates, rent, grocery store, we all know that. So you should be, I know a lot of the old school doctors that I deal with, they never raise their charges. You have to look at them. And what we recommend is there's two ways a lot of people do it, is look at the highest commercial insurance payer that you get for us to be a service, 99213, 99214, just look at the top 15 or 20 CPT codes, look at those and get those right at least. That will cover 80% of your business. So look at those charges, charge 200% of the Medicare fee schedule for your area, or if you want to charge a little less than that, some people will look at those commercial insurance claims and the highest payer, take that and then add another 30% to it, and then let that be your charge. Because remember, your traditional Medicare patient has a co-insurance of 20% of your actual charge in a rural health clinic. So you'll actually be charging them more than if they went to a fee-for-service clinic, because a fee-for-service clinic has a limiting charge on that. They can only charge $17.25 or some such number for a 99213. Well, you can charge 20% of $229 to that patient. So we can see now that our Medicare cost, we actually only, even though the rates were much higher, we went from getting paid $61 a visit in 2020 to $93 a visit in 2024. Remember, you don't get your rate. Remember, you get 78.4% of your rate from Medicare. The other 20% is 20% of charges as a co-insurance, and then the other 2% is the government keeps for sequestration. So the variance is, yes, we went up by 51% in our payments for that 4-year period of time, which is great. But again, we had lower volume, so our net cash was only 9% more. Deductibles, there's a $240 deductible for your Medicare patients. What happens is there's something called negative reimbursement at the beginning of the year, where Medicare takes that money away from you. If your rate's $139 and you charge me $240 for my deductible, Medicare will actually take away $101 from you. So most rural health clinics, they try not to bill in January and February and let the cardiologist eat this. So you can see this particular clinic, their average deductible per patient was only $25 because somebody else was eating that deductible. And so there are a few patients that squeak through that you have to do them. So and then the co-insurance, which this is 20% of charges, because the overall charges went down, that number went down. Of course, the co-insurance per visit went up. $46 per visit is what the average person is going to pay as a co-insurance, or Medicare patients can pay as when they come to this clinic. Collections per visit, we were only averaging $115 in 2020. Now we're averaging $164 per visit. I mean, that is a 43% increase, which if you look at the inflation numbers, that's probably what the real inflation is, not those sort of made up BLS numbers, which, one of my first jobs out of college was going to Washington, D.C., working in the Bureau of Labor Statistics. And basically, we would try to be very creative in coming up with BLS numbers that weren't as high as they probably should be. So and that was 40 years ago. So I'm sure that they're more sophisticated now than we were back 40 years ago. And then, so collections per visit, 2024 is averaging 184.28. So that was from a statistic that I read somewhere. I think it may be showing up next year. So again, really try to collect that cash and get your revenue cycle going. This is important information for you to know. Another thing that these higher payments from Medicare impacts is your Medicare, Medicaid dual eligibles. For Medicare, if you have a patient who the co-insurance, that $46 co-insurance we just talked about, or that $240 deductible, if you don't pay it and you do all the right collection efforts for it, then we can put that on the cost report, and Medicare will reimburse you 65% in addition to your all-inclusive rate. If it's a Medicaid patient, it should automatically cross over to Medicaid. And again, every state is different. So look at your state plan and what your state is doing. But a lot of states, when it crosses over, it will look at how much Medicare paid. If Medicare is now paying you guys $109 a visit and your Medicaid rate is $102, what that state will say is, well, you've already received more, $109, than we would have paid you if Medicaid was primary. So we're not going to pay you anything. And what happens is that's not an adjustment where you just write it off, oh, well, shoot, we don't get anything. What you want to do is put that on your Medicare bad debt listing, put it on the cost report. That is a crossover bad debt, and Medicare will reimburse you 65% of that. That one you need to get on it right away if you think that's happening, because you're going to get page after page after page of these that you're going to put on an Excel spreadsheet and present to Medicare. So I know Trent is our bad debt person there. Do you have any more to add to what I just said, or some tips and secrets to that?
Trent? You covered the majority of it. I would say just make sure that your date of ceasing collections is falling within the fiscal year end of the cost report. That's the most important thing as far as making sure that it's eligible. And double check when you're filling out your Medicare bad debt log that all of your dates that are on there are accurate, because those are things that will get checked both by us as we're checking it to put it in the cost report, and then also more importantly by the MAC when they're reviewing it. So just make sure your dates are accurate, and in particular that date of ceasing collection efforts. I just want to make sure that those are in good shape.
Yeah, that makes a lot of sense. So this is something I will go back and double check everybody for your Medicare, Medicaid crossovers, because this may have changed from what it was. And typically you have to look at this every so often just to make sure that you're not missing out on some money there on this crossover bad debts. As you can probably tell from what we've said so far, it's really super important to have interim Medicare cost reports. Number one is just getting a accurate projection on what your actual costs are, and maybe if you need to file an interim cost report. And number two is if you do have a big payback looming for Medicare, you can sort of make some plans like, okay, we're gonna have to pay back some money. We need to get a line of credit set up, or maybe we need to pay some compensation. Maybe we need to do something different, because what happens is if we do an interim cost report and we know that we're in a situation where we need to do something, if we didn't know this and we waited till after the end of the fiscal year is over, it's sort of like my mother-in-law back in the day, God bless her. I would do something stupid, and then she would give me all sorts of advice on how I could have avoided that. And there's this old Danish proverb that says, advice after injury is like medicine after death. That's sort of what it's like. I mean, once the year end is over, we can't revive the patient a lot of times. But we can resuscitate you if we get something, if we know about it during the year. We can tell you something to do that will at least mitigate the effect of the payback. We may not be able to avoid it completely, but we can at least mitigate the effect of it. So that's why it's important that you do these. Again, cash flow, compliance with Medicare guidelines. Also, if there's things that you're not doing, maybe you're not doing time studies for your doctors, your nurse practitioners, your PAs that you need. That is something you'll pick up during the year. Maybe especially if you're a provider-based RHC, you really do need to do good time studies so you can allocate your expenses, because you're going to be pushing a lot of general overhead and a lot of hospital overhead to your rural health clinic that you're going to capture through what's called B-1 statistics on the Medicare 2552 cost report. And if you can keep good statistics, you're going to get a good cost per visit, and you have a better chance of reaching your grandfathered RHC rate. I know it's a terrible feeling when you do one of those provider-based RHC cost reports and it comes in and your grandfathered rate is $226 and you're coming at the cost per visit $75. And I've seen that happen. And if they'd have kept good statistics and they could have allocated some general overhead over there, they could have gotten very close to hitting their number. So that's why this is important. Timing of the interim cost reports. Typically, if you're provider-based, you'll want to do a quarterly report. I know I was a controller of a hospital, several hospitals, that I always hated that part of the job, which was every quarter we would do an interim cost report and we would compute contractual adjustments and we would true them up to the cost report or to the financials the best we could, because that was super important. So if you're provider-based, that's probably something you need to be looking at. If you're an independent, that's probably a little overkill. What we typically recommend for our independent RHCs is maybe about halfway through the year, do an interim cost report, and then at the end of November, when we've got January, maybe at the end of October or November, do an interim cost report again, so that we can do that pre-year-end final report and make any last-second adjustments so that we can sort of revive the patient if we need to. So that's highly recommended that you do that. Let me see here. And then track your costs regularly. Again, upfront, good chart of accounts, good accounting system, putting things where they need to be. It's going to be important. Second item is payroll and staffing costs. A lot of times you may lose a physician, you may lose a nurse practitioner, or you may be adding a physician or a nurse practitioner. Your expenses could be going up. with that or going down with that. And you need to see what that impact is before we can revive the patient. And finally, patient volumes. Again, if you're losing providers or adding providers, what is that volume doing to your all-inclusive rate? That's why these interim cost reports are so important. As a rural health clinic, under Medicare, you are required to have accrual basis accounting, which I know a lot of you guys are small clinics, and that's really, you're not accountants, and it's hard to do, but you have to have the proper matching of expenses to the period that they're incurred. They may not necessarily be paid. You can actually accrue the expense for the year it's incurred, and then if you follow the proper Medicare rules, you can claim it on that cost report. So the typical rules are for an owner of the business, you have to liquidate that within 75 days if it's related to compensation. If you're somebody who's not related to the clinic, not an owner, then you have up to 1 year to liquidate that accrual. Another big key is tracking your non-Medicare costs. Those things that I talked about earlier. There's laboratory, there's chronic care management, there's hospital, there's medical telehealth services. There's a couple more in there, but there's a list coming up after this. You need to track those costs during the year with your general ledger. Keep those in separate places because we need to pull that out of the cost report as a non-allowable expense. So make sure you work with your consultants here, with with HBS, with Julie Quinn, David James, Whiffley, all the people that are on that NARHC vendor list there. There's a lot of great people out there. Todd Johnson, those people, work with them to make sure you keep up with your information during the year. And then knowing what the legal entity impact it has on owner's compensation is super important. And then here's what we talked about, keeping a separate account for this. And then here is the listing. Hospital services, anything you do in a hospital is not covered under the RHC benefit, has to be carved out from the cost report. Laboratory, and even including the 6 required lab tests, those you carve that out and keep up with those expenses because we're going to pull that expense out of the cost report. Technical components, if you have an X-ray machine, your EKG machine there, that technical component, that 93005 piece to that technical component is a non-allowable expense on the cost report, and we pull that out. Your CCM, the CCM companies we talked about, your remote monitoring, all of that, keep up with it separately. We're gonna pull it out. Telehealth, again, if it's a mental health visit, that's included in the all-inclusive rate. If it's a non-mental health visit, then it's not included in the all-inclusive rate, and we have to pull that expense out. I wish they would just be consistent on that because that makes it hard for you, and it makes it hard for us to do these cost reports accurately. Here are the different types of services that you would see in a rural health clinic. This green column, these are things that are in the all-inclusive rate, and they go on the cost report as an allowable expense. Office visits, 992 and 3, 992 and 4. Incident 2 services, allergy shots. That's the big one there. Mental health, telehealth visits are all part of the all-inclusive rate. Lab draws, even though 36415 for drawing the blood, that is not considered a lab service. Doesn't make any sense to me, but they changed that in like 2006. So drawing blood is the part of your all-inclusive rate. Radiology service, the professional component, the reading the EKG that says Mark is in AFib, that is a part of your allowable cost. It goes on the cost report. Here's a non-allowable section here. This is the red section. We just went over those. The only one we didn't is private practice time. Private practice times, if you're doing a lot of Botox, a lot of weight loss, a lot of sort of spa type of stuff, you probably want to set that up in a private practice time and keep up with that expense separately and we'll want to pull that cost out of the cost report. So that expensive Botox that you're buying, keep up with it separately. And then there's another category which goes in the green, which is pass-through costs. This is actually paid above this your all-inclusive rate. So these are add-ons that you can get extra money for. Influenza vaccines, pneumococcal vaccines, COVID-19 vaccines, they pay you in addition to your all-inclusive rate. The Medicare bad debts that we talked about, you're going to get 65% of your actual of the actual bad debt if you do it the way Trent said to do it. And then if you're doing graduate medical education, you can get direct reimbursement for that as well. Now this is just the detail of some of those expenses there. This goes over the type of expense that there, what cost center it goes in currently, how it's paid through the cost report, and then finally, whether or not you count it as a visit or not. So I won't read through each one of those sections there. Accrual of expenses, again, if you're accruing compensation to owners or certain self-funded insurance plans, you have to liquidate it within 75 days of year end. When I say liquidate, I mean write a check and cash a check. I know a lot of doctors always say, well, can we just write me the check and I never cash it? No, that doesn't count. And then non-owners, you have 12 months to the end of the year to do that. Pension contributions, that is a good thing to accrue. Payroll to employees, that is a good one. Accrued vacation and sick pay. Those are good accruals to help increase your cost per visit. How you compute your all-inclusive rate? At one time, it was super easy. We just took your total expenses minus the flu and pneumococcal costs, because they pay for that separately. Divide that by your total visits. That includes all payer types, Medicare, Medicaid, self-pay, no pay, and that would equal your cost per visit, which will be limited to the cap, and there is a productivity standard there. Physicians have to see 4,200 visits for a full-time year if they're working 40 hours a week. Nurse practitioners and PAs have to see 2,100 visits if they're working full-time. That will be, if the proposed rules stand, that should be going away next year. So that will be great. There won't be any more productivity standards if the rules are as they stand, but currently for 2024, that is still a rule. Next year, we may not have to break out our business between nurse practitioners, physicians, and PAs, because there's no caps, because there's no productivity standards anymore. But we don't know the answer to that yet. We don't have a final rule. So keep doing what you're doing until then. The new way is your total allowable costs minus your flu and pneumococcal, minus your CCM, minus your telehealth, except mental health, minus lab, x-ray, minus non-RHC, minus virtual communications costs, minus the cost of hospital visits. And then divide that by your total visits, by payer, minus telehealth visits, except mental health, minus visits for non-RHC, hours, and in the hospital, do not count CCM service. Y'all can see why I am retiring. I mean, oh my goodness, being 65 years old and dealing with this, this is a young person's game. So here's some summary of what you guys need to do. Track your expenses when they've occurred. Don't wait to the end of the year and do some Excel spreadsheet. Try to come up with it. It's going to go poorly for you. Match the expenses to the period. Again, accrual basis accounting. Keep up with your allowable and your non-allowable separately. And then keep good documentation. Have a good system to find your documents. If you are brand new to the RHC program, depending on what state you're in and what Medicaid program you're dealing with, they will typically have a base year cost report. They will audit that report to no end. We work in Kentucky and Alabama a lot, and they will look for pretty much every invoice and every little nickel you spend. Keep great records. If you're in a base year, if you're brand new to the RHC program, reach out to Medicaid and find out what they're going to want at the end of your first year. Again, that's working with your experts in your particular state is going to be really important. Somebody who understands. We understand Tennessee, Alabama, Kentucky, because they're close by. I know at the NARHC virtual hour session, somebody asked me about Michigan. And I said, oh, you need to talk to Chris Christopherson. She lives there. You need to talk to Julie Quinn because they work there all the time for a Michigan Medicaid issue. So find somebody in your particular state who knows that particular state. Let me see here. Allowable compensation, and we're getting pretty close here, getting close to the end. There's sole proprietor, LLC, which is this, an LLC can be anything. Unfortunately, LLCs are hard to classify because they can be sole proprietor, they can be a partnership, or they can be a corporation or an S corporation. It's just however they choose. They're a chameleon. So LLCs, you really have to do a bunch of research on those, on how you get your compensation on the cost report. So best way for me to explain this is to use this: a sole proprietor and a single member LLC. And you gotta double check this. I need to put a little question mark on this because this one may or may not be true, but typically if the LLC is treated as a partner, if it's single, it's gonna be treated as a sole proprietor. If it's a multi-member that elects to be a partner, then it's gonna be eligible for value of services. And what value of services means is we compute how much that physician owner is worth using studies. And if he's worth $420,000 or she's worth $450,000, but we only have enough cash to pay him $200,000, we make an adjustment on the cost report to say Dr. Trent was worth $450,000. We only paid $200,000. So we're going to make an adjustment to increase our allowable compensation by $250,000. We never write a check. We never tell the IRS, and that adjustment increases the cost per visit and increases your all-inclusive rate. That's pretty powerful thing to use, but you can only use it on these particular entities. If you're a corporation or an S corporation, the compensation must be paid. It can be liquidated within 75 days of year end, so you have a 75-day accrual for them. But knowing that up front can help you plan on who gets paid what, whether it's allowable on the cost report or not. So it helps you do a little planning to optimize your amount of reimbursement on the cost report. Here's where people, when I say this all the time, people say, Mark, that's just dumb. You value of services, we don't ever pay it, but here's section 907 of the PRM manual where it says that partners' value of services rendered by the owner, such amount may or may not be represented by actual payments made to the owner. There's no direct relationship between compensation and the clinic's operating profit or loss. So there you go. That is a very powerful thing. We needed to actually put out a list here of recommended sort of reasonable salaries. They haven't updated it since 2014, so we've got 10 more years since then. It's probably not a great listing anymore because the COVID thing that jumped everything by 40%. So we use some benchmarking reports. Wifley has some great benchmarking reports that you can use. If you're a member of the NARHC, go ahead and talk to Tasha or Kate and get them to send you your benchmarking report to see what your numbers are. Also, you can go this website here. This is brand new. The National Association of Rural Health Clinics put this up. There's some RHC data out there on rural health clinics. It has all the 99213s, 99214s, how much people are getting paid, what the charges are. I mean, it's really pretty neat. So, and it just came out a few weeks ago. So you'll need to look at that to see. You can see here, this is for provider-based here, average compensation per visit, and we can use some of these numbers. Average compensation FTE for a physician, 434,000. So these are 2022 numbers. So these numbers are much higher now when we inflate those going forward. So use those numbers. Here is an example that I just described to you, Dr. Welby. And this happens a lot. When you first become a rural health clinic, let me tell you, your cash flow gets destroyed because you're having to re-enroll with Medicare and Medicaid, and they take forever, and they're taking longer and longer. Now it's becoming more and more of a problem. And a lot of times your owners are the ones that don't get paid. And so this is a powerful thing to use during that period of time. Just keep in mind, Medicaid is Medicaid in each state, and they may not recognize value of services. So talk to your consultant to see, make a plan to see what you need to do to get your Medicaid rate as high as it should be as well. So here's some of the AI stuff that I printed off. I'm not going to read this and go over this, and you're saying, thank goodness for that, because this would be forever. So, but I'm not going to read all of this, but just I'll put the rules in for you. Some of it may be a little, maybe I read a few of it, and I was like, okay, this. I'm not sure if I like that answer or not, but we'll work on it and get it better as we go along. But for the most part, it was 99% right. So those are the different things. Look up what you are, and then read what you can do as your rural health clinic. If you have any questions, just let me know. But I think this is key here. Make sure it's reasonable. Make sure you have it documented. Put in some administrative time. You're doing administrative time, ask for compensation for that, and then try to get as much physician compensation as you possibly can. So, and then basically summarize and document everything. Also, allocation, one thing is having separate cost centers. We've emphasized that over and over. If you're a provider-based rural health clinic, get with your controller, your CFO, make sure you're doing all of your statistics correctly. That's going to make sure you get as much cost allocated over to your clinic as possible. Now that sounds like you don't want that, but you do from a cost reporting standpoint, because you want to get your cost per visit as high as possible. That's going to increase your reimbursement if you do that. The B-1 step down is a way that you can capture a lot of those hospital costs there. And I'm going to move a little bit faster. Also, strategic use of low utilization cost reports. If you don't have a lot of Medicare utilization, and we define that, or Medicare defines that as less than $50,000 of net reimbursement from Medicare, you can file a low utilization cost report. If you have no utilization, if you're a pediatric clinic, you can basically just send in a report that says, hey, we're good. We don't have any Medicare, you know, why are we even doing this sort of letter? And so you're good to go there. Except in Louisiana, you have to send one in no matter what. Louisiana's always different. You can't do a low utilization in Louisiana either. But if you qualify for this, if you have less than $50,000 of payments, it's basically sending a letter and a balance sheet, and you don't have a lot of flu, pneumococcal, bad debts, all those other things, because you have to file a full cost report to get paid for that. Then you need to, you could do a low utilization cost report. If you do that, basically what you want to do is get your PSNR report at the beginning of the new year and see where your payments are and see if you qualify for it. Because if you do, we'll go ahead and submit it in early and you'll be done with it. The reason why you'd want to do it is if you have less than 50,000 and maybe your cost per visit actually came up less than what it is now, because they raised the cap by $13 a visit. It's at $139, and now your cost per visit is $127, and you would have back a $8,000 or $10,000 payback to Medicare. You could file a low utilization cost report, avoid paying back the $8,000 or $10,000, and keep your rate at $139. And then maybe in a few years from now, you'd file a full cost report and then start that process over again. So that's one way that you can sort of leverage low utilization cost reports if you qualify. Productivity, we talked a little bit about this earlier. There's FTEs. Right now, you have to keep up with them because there are productivity screens. Also, if you're counting visits for your cost report, the one thing that you want to do is don't use a payer mix count. Use a CPT frequency report, because if you use a payer mix report, it's going to double count. If a patient has Medicare primary and Medicaid secondary, oftentimes it will double count. And as much as you want your visits to be 20,000 visits a year or 30,000 visits a year, it's going to hurt you when you do the cost report. So keep that in mind. There was the productivity screens I showed you earlier. Here's the documentation. What I would do is at least once a quarter, have your providers fill this form out so that we know what they're doing, because the lower their FTE is on the cost report, the less an impact productivity screens have. So just the opposite here. We want your FTE time for your physician, nurse practitioner, PA that's directly seeing patients. We want that to be as low as possible, as low as reasonable on the cost report. So that's why these types of things, you really need those. Related parties, I just say if you have related parties, you want to disclose those. And if you're paying yourself a huge fee of rent, you are basically just self-disallowing expense on your cost report. If you own the building and the clinic is, and you also own the rural health clinic, talk to your accountant to see what should my rent be to maximize my tax benefit, but also maximize my cost report benefit. Because if you're paying yourself $500,000 in rent, when we do the cost report, we're going to disallow that whole $500,000, and that's going to tank your AIR. So keep that in mind. If your wife owns the building and you're renting it from her, same rule applies. So keep that in mind. Here's your reading list, things that you can do to keep up with cost reporting. Here's the benchmarking report from the NARHC. If you click on this link, you can go there and get that. And wow, I did that in 56 minutes. Questions, Dani? I know I did that fast, so.
No, you're good. There's only one, and I answered it, but I'm gonna let you answer it for everybody else. Scott asked, when figuring compensation of a physician owner in an LLC, does percentage of ownership of the LLC come into play?
Does the what now come into play?
The percentage of ownership.
I don't think it does. Dani, does it not matter?
That's correct. It doesn't matter. Okay. And then I just kind of elaborated and said the most common way that we do it is taking that benchmark number that you mentioned for the average cost per visit of a physician and multiplying that by the number of visits that physician owner saw that year.
Yep, that's exactly right. So, or at least that's the way I've always done it, and it's worked for 35 years. Hopefully it'll continue working. Okay, so that's only one question we had.
Well, Jennifer Coble has her hand raised, so I'm going to unmute her and let her ask her question.
Okay.
Okay, Jennifer, your line's unmuted on our end. It says you're self-muted, so if you have a question, you may need to unmute yourself before you speak. Okay.
Okay, Tony's on here too from NoSor. So Tony, I've unmuted your line. You can talk if you want to. There you go. You're self-muted. There you go. You're open. Hey, how you doing?
Hey, Mark. I just want to say on behalf of myself and the National Organization of State Offices of Rural Health, we are devastated that you are going to be retiring, but we wish you the absolute best in your next chapter of life. You have been a tremendous and valuable resource, not just for the rural health clinics, but for the national organizations and myself personally. And just thank you for your tremendous years of service to rural and rural health clinics.
You'll make me cry. Thank you, Tom. So I appreciate it so much. It has been a labor of love. Let me tell you, it's just I love the people. I love their passion for taking care of these patients. So it's amazing. So thank you.
Okay, Mark, Jennifer typed her question in. She asked if a provider works 36 hours, is that considered full-time? How is that handled?
36, what you do is you take 36, you divide it by 40, and that gives you a 0.90. So when we fill out worksheet B, we're going to put that your provider is a 0.90. That means that we're going to multiply 0.90 times 4,200, and their productivity screen is going to drop down to 3,600 or whatever that number is. So that's how that will work.
Okay. Scott actually raised his hand. He was the one that had asked about the physician owner comp. So Scott, I've unmuted your line. I don't know if you had a follow-up question.
Yes, thank you. Happy retirement, Mark and Joy.
Thank you.
My question was more in regards, and maybe I should have worded it different, more in regards to administrative time that you would be able to allocate to physician owners of an LLC. Does the percentage of, and maybe you answer this, and maybe I'm misunderstanding, but does the percentage of ownership come into play when you're allocating that administrative time for, and in this case, we have co-medical director, so 2 physician, 5% owners of an LLC?
Yeah, Danny, my answer would be it would not. It would really depend on your time zones. If you're spending 4 hours a week or 8 hours a week on administrative stuff, I would document that in that little schedule that I showed you earlier. Document that, and then we'll take that number, we'll multiply that. Typically, you'll go on salary.com, see what administrative people in your particular area are making. So, you know, average salary for administrator is 180,000. We multiply that by figure out the 4 hours and say, okay, we have $30,000 worth of allowable time for Scott for this administrative piece. And then your other medical director, whatever time they have, we'll do the same process for that for administrative piece. Danny, is that the way you would describe it?
That's exactly how I would do it. Yes, sir.
Okay, Scott, does that answer your question, or do you have more?
Yes. No, that answers my question. Thank you.
Okay, no problem. Thank you.
Mark, I think the only thing we have left is Diane asked for you to repeat how she could get a copy of this presentation.
Okay. One is you could go to the Facebook group there, join Rural Health Clinic Information Exchange, and I posted it there. Number 2 is it's in your handouts. If you'll click on it, hopefully it'll download. If it doesn't, if you go to ruralhealthclinic.com, on the home page, there's information about this particular webinar. It's on the home page, so it's right there, and it'll just say the slide presentation is click here, and if you click here, it will download a PDF of it. So, okay, well, thank y'all, thank everybody. I'm sure we'll see you at least a couple times before, and if you're going to the National Association of Rural Health Clinics, Trent and I will be there. So look us up, and we'll be glad to see you there. Thank y'all for everything. Bye, everybody.